Welcome back to the channel. Today you're going to be building wealth with me, Jacob, as usual. And I want to talk specifically about buying and holding index funds, but specifically S&P 500 index funds. Now, buying and holding index funds isn't a nominal idea. It's not new. It's been around for like 50 years. And if you want to skip this entire video, you want to hear which S&P 500 index fund I prefer buying, I like Vanguard's VOO. But if you want to know why, then stick around. So there's three index funds, and I should actually call them ETFs because that's what they are. They're not index funds, they're ETFs, exchange-traded funds. And for all intents and purposes, they're the same. Indexes were really big like 50 years ago, but now people buy ETFs, and we still call it indexing. Whatever. So there's three of them. There's State Street's SPY, there's Vanguard's VOO, and there's BlackRock's IVV. Now, they're not all created equally. Each one has its pros and cons, and I want to go through them. So whenever I look at ETFs, then I like to look at three specific things inside of the ETF. I like to look at the net expense ratio, and that's how much you'll be paying if you buy that ETF and hold it over a long period of time. I like to look at the distribution yield, also known as dividends, that the ETF will pay to you if you buy and hold it for a long time. And I also like to look at the fund's 10-year performance. So let's get into it. I've created this chart here in Google Sheets of indexing what matters S&P 500 ETFs. And I got the three ETFs up here at the top: State Street's SPY, Vanguard's VOO, and BlackRock's IVV. And on the side here, I also have 20-year personal return, $100,000 invested. So this column is going to specifically just be like a pretend column of if I invested $100,000 into this index fund, what would it give me over the next 20 years? Because that's what people do when they buy these index funds or ETFs. They just buy, hold, and wait 10, 20, 30 years. So let's pretend that's what I'm doing here. So with State Street's SPI, we want to look first at the net expense ratio. We see that it's at 0.0945. It's not very high, but compare it to Vanguard's VOO, that is a 0.03% net expense ratio there. And also with BlackRock's IVV, they have a 0.03%. So my immediate thought is, while 0.09% from SPY is low, it's still 3 times higher than that of BlackRock's and Vanguard's. So why would I pay more? Well, we'll see if I should. So over the 20 years, that net expense ratio would add up to be $1,890. That's how much I would pay out of pocket to be holding this ETF. Now, if I were to buy and hold Vanguard's VOO for 20 years, I would pay them a total of $600. And likewise, BlackRock's is the exact same $600. So overall, I am paying about $1,200 less if I buy BlackRock's or Vanguard's ETF and I hold it for a long time. Now, let's look at the annual distribution yield or those dividends. So State Street pays 1.21%, Vanguard's 1.29%, and BlackRock pays 1.31%. So again, SPY is losing here. They have the highest net expense ratio, and they have a lower payout on those dividends, BlackRock being the highest, and then Vanguard. So I'm not really liking State Street's SPY right now, and we'll continue. Lastly, I'm looking at the fund's 10-year performance. Now, the 10-year performance is obviously historical returns, but what it tells me is that whoever's managing these ETFs over at State Street, over at Vanguard, over at BlackRock, this is what they've been able to manage and come up with so far. And not all of these funds are built the same. So while they all are focused on S&P 500 mega cap stocks, let's say, for example, State Street's #1 holding is NVIDIA and Vanguard's #1 holding is Apple. Well, if NVIDIA's outperforming 1 year over Apple, or is for the long time, then SPY would perform better over Vanguard. So they are made up a little bit differently. The idea of them is almost the exact same, and you'll see that here in the return. So SPY has a 10-year performance of 12.77%. Vanguard's is 12.82%. And BlackRock's is 12.83%. So again, BlackRock came out on top, Vanguard came in second, and then SPY came in the last. So SPY has the worst 10-year performance. It has the lowest distribution yield, the dividend, and it also has the highest net expense ratio. All of that tells me that maybe I really don't want SPY. Actually, I can tell you right now, I don't want SPY. So if I were to buy and hold SPY for the 20 years, then after paying my expense ratio, I would have $1,087,000, and that's with $100,000 invested now. With Vanguard's VOO, if I put in that $100,000, I would get $1,110,000. And BlackRock's IVV would pay me out at $1,112,000. So looking at SPY's performance compared to Vanguard's VOO, if I bought Vanguard's instead of SPY's over 20 years, that would give me $22,000 more dollars. Likewise, if I bought BlackRock's IVV and held it for 20 years over SPY, then that would pay me out at $24,000 more dollars over the long term. So holding an index fund or ETF for a very long time, net expense ratios do add up. Compound interest adds up. The performance adds up. The dividends add up. Everything like that does add up. So right now, IVV actually looks like the best, but I will tell you that all those numbers do change. The net expense ratio can change over the years. It's not set in stone. It has to stay at this specific net expense ratio forever. Distribution yields can also go up, and 10-year performance can get better or worse depending on the fund. Now, I've been doing this for about 5 years, and BlackRock's IVV and Vanguard's VOO are always about the same. Sometimes VOO is better on these categories than BlackRock's IVV, but I've never seen SPY be better than either BlackRock's or Vanguard. So I chose just to buy VOO and stick with it. But BlackRock's IVV is also great. I do own some IVV as well as some Vanguard's VOO, because in the beginning I started buying IVV instead of VOO, and then VOO got better in terms of these numbers, but barely. And now IVV is better again. So you see what I mean? They kind of flip-flop between BlackRock and Vanguard. I think they're both great. I think State Street's SPY is the worst of the bunch. You can clearly see here why. So yeah, if you're looking for any S&P 500 ETFs to buy, hold, and wait, I would consider looking at these three and then saying, which one do I like the most? You already know my answer. See ya.